Hey guys, good morning. Hope everybody's doing well. Just text in the chat box if you can hear me okay. Good morning, Kirk. Greg, how you doing? Jeff. JD, glad to see you here. Chari, good morning. Donnie, good morning. Great. Boy, I'm glad you guys could join me today. Hey, really, some really interesting stuff going on. I found a couple of things that I thought you guys would be interested in, and I'm going to share those with you today, as well as go over some setups for the current market. So let me go ahead and share my screen. As soon as you can see my screen, let me know. Got it? Awesome. Okay, good. So remember, please use the chat box if you have any questions at all. And if you have a more complicated question, because we've only got about 8 or so on the line, we can open up the voice for you if you want to ask a more complicated question and do it audibly. Otherwise, hopefully you guys are doing good. We got a little bit of a downdraft in the market today. Let me just minimize this back. I'll keep an eye on the chat here for you. But yeah, a little downdraft here yesterday. Market Timer was coming out with their update and basically said that the one of the things that's interesting is the flow, which is an indication of a top in the market or a bottom in the market. It declined just 1% on the Dow and the S&P 500. And typically when a move is over, the flow declines 10% or more in a single day. And so we haven't seen that, so they're indicating that the more selling is coming. On the NASDAQ, the flow actually increased from up 4% to 107%. So we're anticipating a continuation of the down move here. It looks like we're getting a little bit of it this morning. The futures were down over 130 points at one time early before the market opened. We're starting to come back now a little bit. But if you take a look at the supply-demand, we're negative on the NYSE, and we're also negative now on the NASDAQ, but it was positive earlier. In fact, it looks like a little institutional buy order came in here. It was plus 25, but if you go down to the 1-minute chart, you'll see that it was offset here. So we had a minus 11, we had a plus 25. So a little bit of an offset order, a little bit more to the positive side. And in the early morning, actually, it was up pretty high. It looks like it's settling down now, so that both the strength index on both of the indexes are negative, as well as the supply demand. So we'll see if they go positive, but for the most part, I think we're going to see somewhat of a negative day today. It looks like the NASDAQ is gaining. Maybe it's short covering. It's kind of hard to say. NASDAQ's been hit pretty hard over the past week. Let's take a look at Market Timer XL. Market Timer XL is negative, but it's not as high as I anticipated. It should be up around the 70 level, up in this level, and it's only at 60. So I'm not really sure if, but the lines look good. So we could have a continuation here. Let me go down to an hour chart. Looks like a little buying on the dip here by most traders coming in this morning, seeing the market weakness. Yeah, it's not terribly weak right now at like 60. That's not a really weak reading. We'll see if it continues to strengthen during the day or get weaker during the day. But right now, we're still down 43 on the futures contract on the YM. Cash index is only down 11 points. All right, so that's kind of the opening setup. Yes, I did have a very good vacation. Thank you, Chari. Down in New York City for the week. It was a really nice week. Hot, though. I was anticipating a little cooler weather, but it was nice. It was up around 95. It felt like 100. But it was good. And I came back to upstate New York, and it's like 45 degrees up here. I don't know. It was just on the plane ride. It was like 75 in New York when I left. And I'm only 4 hours away by car, 4.5 hours by car, and an hour by plane. And I got here, and it was like sub 60. It was ridiculous. But anyways, a very nice vacation. I always enjoy going down to the city. I caught an off-Broadway show, went to a couple of jazz clubs. I really like the Jazz Standard. If you ever get to New York, my favorite venues for jazz is the Jazz Standard. I do like the Lincoln Center a lot. Dizzy's Club is really nice. And I also like Birdland. Birdland is great. Okay, guys, I'll handle any questions you guys got. And then I got something I want to share with you that I found recently online. Any burning questions you guys got? Everybody's good? Can you take a short when ST and SD are positive? I'm not sure. Dan would probably not have done that. You mean a short YMNQ position or just a short? Okay. Yeah, the swing signal is. Oh, good. Thank you. Yeah, I appreciate that. Uploaded a updated ARB sheet. You mean this one? Okay, yeah. I'll upload the current one here. They're really easy to update now. Excuse me. All you have to do is put in the date. So you just fill in the date. And you go ahead and get the cash index from whatever source you're using. I'm just taking it off of TD Ameritrade. And you don't have to put the cents in there. Just put in the raw numbers, the first four, 74, 71. And it's really easy to update this sheet. Very, very easy. So I'll upload this for you, and you can have it. I could try to share it in this chat box. It's a little tough, I think, to get, but let me see if I can do that. Share a file. See if I can do this. Make sure I pick the right one. YMNQ. I think what'll happen is a little box will pop up, and you have to click on it to share the file. So try that. If it doesn't work, I'll put it up into the HOLM1 download page, and you can download it from there. There is one there, but this is the most current one. Okay, so let me get back to the question here from Charlie. So he took it, even though ST and SD are positive for both, yes, absolutely. So it doesn't matter if YMNQ are going up or going down. It has absolutely no bearing on whether or not you're going to take a short arbitrage position or a long arbitrage position. The only thing that matters is the percentage change in the YM and the NQ. So right now the NQ is down, the YM is down 0.05%. The NQ is up 0.19%. So the difference is approximately a negative 25. In fact, we just did the update on the spreadsheet. It was negative 0.29. So that's on the cash index. The futures are approximately 26. So it doesn't matter what is going on with the individual futures contracts as long as the spread is, so as long as you're setting up the trade based on the spread. And also, when you take a look at this, if the YM is stronger, as far as SD and the ST is concerned, stronger than the NQ, even though they're both positive, yes, you take either a long or short position. So for example, right now, they're pretty close together. So there's not much of an edge here for the YM-NQ. Earlier, the NQ was much stronger than the YM. The SD on the YM was still like, was -5, -6. And the SD on the NQ was actually positive 7, 8, 9. So in that case, you want to take a short arbitrage position. You're going to sell the YM and buy the NQ. And then you want to track it here with the oscillator. And so when it gets to, it's -22 now, then you want to take your profits. But yes, you can do, it doesn't matter if the YM is going up and the NQ is going down, or they're both going up or they're both going down. It has absolutely no bearing on the decision to go long or short the arbitrage trade. The only thing that has a bearing on it, number one, is the percentage change difference, which is actually represented in the ARB oscillator. And then the strength. So if the YM is stronger than the NQ, you're going to go long the YM, short the NQ. If the NQ is stronger, you're going to go long the NQ and short the YM. Hopefully that answered your question. The trigger and the trend are not updating for some reason. Well, you have to copy them down. So for example, like on this particular column, I didn't copy them all the way down. So what you do is you highlight the cell, you place your cursor right over that corner, and when you get a black cross like that, you just click on it and then drag it down to the next cell, and it will automatically copy down the cells. But I think there was something wrong with the upload the last time I did it to the download section, so I'll upload this one again. Absolutely. All right, let's get into something I found recently. I think you guys might find interesting. Before I do that, though, has anybody heard of the website called Chat with Traders? Have you guys seen this website, Chat with Traders? It's run by Aaron Fifield. Anybody's ever seen this before? Let me say, I can't. I'm just got to scroll down here. Greg has, yes. First column off the data, so leave it down. Okay. All right, well, I'll fix that with a new upload. Jeff says no. Very interesting stuff here. I hadn't heard of it before, but I was doing a search for a Tom Sosnoff interview, and I found it on Chat with Traders. There are very few websites out there that I actually visit when it comes to trading, because almost everybody who's doing anything, selling systems or, doing anything like that, typically has a, they're just insane when it comes to their marketing tactics. And the more prevalent I see them, especially on YouTube videos, are the ones I stay away from the most. So typically, I don't really get into a lot of other places online where people are talking about trading because most of it is total garbage. They have absolutely no idea what they're doing. Especially the ones that are constantly barraging me with ads on YouTube. But anyway, this one in particular caught me by surprise. I think this was a absolutely fantastic interview with William Siemba. Dr. William Siemba, according to the bio here they put up here, is an academic, a practitioner, gambler, trader, and an author. He's got close to 20 books on Amazon. Hey, Greg, have you ever heard this guy? Have you ever heard this guy talk? This particular interview was really interesting. I just listened to like the first 30 minutes or so, and then I started doing some research on his books. Yeah, you definitely need to listen to this guy. So I've often used the reference that the stock market is very much like a horse race. That when you're trading YM and NQ, you want to buy the strongest one and you want to sell the weakest one. And so it's really a matter of which one is strong, which one is weak, that's going to win the race. And I've used the horse betting analogy. In fact, when I went to Saratoga Springs for the opening weekend of the races there, when I came back that very next week when we did the trading room, I made that reference. And so I found this guy, and he also does a lot. He looks at the markets as a correlation with betting on horses as well. His primary thesis of the market, his primary viewpoint of the market is that there are anomalies that you can find in the market. And that is what you can use in order to generate superior returns over time. And when I created Market Timer, that was exactly what I was looking for. I was looking for anomalies in the market. Anyway, what I'd like to do is I'm going to play a little bit of this audio just to give you a sense of this guy's brilliance. He's really, really a sharp guy, and I think you're really going to enjoy listening to this video or this audio. I'm going to put the link to it for the full interview in the chat box. You guys can check it out yourself. But if you don't mind, I'm just going to play just a few minutes of this because I think it's really, really important, and we'll discuss it. If you can't hear it for some reason, let me know. You should be able to hear it okay. But if you can hear it, please go ahead and type in the chat box you can hear it.
Now, on the podcast this week, I've got a very interesting character for you. The gentleman's name is Dr. William Siemba. William is an academic, a practitioner, gambler, trader, and an author. He's worked with and consulted to many well-respected names in the field, such as Edward Thorpe, Blair Hull, and the very successful horse bettor, Bill Bentor. In the beginning, horse betting was actually William's field of expertise. He even published a book titled Beat the Racetrack. And in many ways, for William, horse betting worked as a gateway to trading financial markets, which he's been doing since around 1983. In 2015, William won the Futures Division of trading competition Battle of the Quants, and now in current times, William manages a fund, Alpha Z Advisors, which has outperformed the S&P 500 by a long shot. The fund started in July 2013, and as of May 2017, it's returned 527%. Much of William's trading revolves around calendar anomalies, arbitrage strategies, and behavioral biases. We spent
The calendar strategies that he's talking about is really interesting. I have not, as I mentioned before, I have not really heard anyone discuss the type of arbitrage opportunities that we're talking about in the YMNQ, the YMES, the YMNQ, ES, and RTY trades. When he talks about calendar anomalies, he actually goes into a story about how he found that in January of each year, and it really mirrors what we found in the YMNQ. So let's continue here. He talks a little bit about it.
Racing I've done for years and years, which is sort of how I learned the stuff I do in the stock market. Basically, I think of it as like racing. The only thing is, the only difference, Aaron, is that in the stock market, futures market, you can stop the race when your horse is ahead. That's one of the differences. And the race ends. That's the other thing. In the financial markets, the race never ends. It's always going. So those are a couple of the differences.
Yeah, I mean,
and then I do the trading discretionary. You have to make fast decisions, and it's a judgment call as to what to do. So that's there, and you have to be basically very careful and watch your risk control and not overbet. Overbetting is very tricky because you can be in a situation where you're not overbet, and all of a sudden the market changes a little bit, and then now all of a sudden you are overbet. So you have to adjust it. So and it's constant work. So you have to really pay attention. If you try to just do it fully computerized, there are people who do that successfully. But for me, I have to do it, with a lot of work. It's like a job. You have to work at it.
We've often talked about that when we were discussing financial markets and computerized trading and algorithms. I think somebody asked if I think a lot of traders try to automatically automate their trading systems, and which is great. It's a goal that you can work towards, and I know that the guys at Strong Market are trying to do that, but they're trying to automate the signals. In the majority of people, you can't automate decision making. I mean, you can't give to the computer something that is basically a judgment call. And that's what he's talking about here, which is, everybody wants to try to automate their trading. Everybody wants to have it completely automated. And there are people maybe who can do that, but just like he's saying, Doctor is saying that most of the time, it's really a judgment call based on the signals that you get from your algorithms. But he makes a really important point here, so let's pay attention to that.
So how come that's the case? I mean, how come your trading isn't fully computerized?
Because you have to make fast decisions on things. Like, for example, in the Trump election, the market assumed that if Trump got elected, it's going to fall. And in fact, when he started winning, the market started out ahead. Then as he started winning, the market fell dramatically, 800 points on the Dow Jones. But there are two Trumps. There's the guy who fires people, who tells the French leader that his wife has a beautiful body, the guy who insults people, the guy who cheats people, doesn't pay his bills. There's that guy. Then there's a guy who calmly reads a speech written by somebody else and does it carefully. That guy, that Trump, is very bullish. So the minute that he, in fact, started the election speech after he had won, the first thing that came out of his mouth was not that Hillary is going to be locked up in jail and all this business. He said, Hillary's a great person. I really respect her. I knew the market had to fly. So you go along. So you have like 5 seconds or 10 seconds to decide what to do. So I don't know if your computer could really do that. You may be able to program it to do this thing, but I kind of doubt it. The VIX, volatility index, finally turned. So it turned lower, and then the S&P rallied, and one went monotone down, the VIX, and one went monotonely up, the S&P. So that was a good one. So you have to sort of, for me at least, have to make these fast decisions. So Ken Griffiths, the famous Chicago trader, he's good enough to buy $80 million Picassos. So things of that sort. His way of thinking is very similar to the way I think, which is you have to understand the theory, you read the stuff, and then in the end, it's a judgment call as to what to do.
So he's a pretty interesting guy. I really encourage you guys to listen to the entire interview. Really, really good stuff. Another person that you should really listen to is Edward Thorp's interview, and also Tony Saliba, who I remember back in 1987 when I was in the market. He had placed big bets on the market declining in October of 1987 and made several $1 million. It wasn't on the general market. I believe it was on one particular stock. But he made a few $1 million in the 1987 crash, and he went on to make, according to this, he made $9 million before he was 30 years old during the 1980s. And I first heard of him when I was reading Jack Schwager's book, The Market Wizards. And so they've got an interview with him too. He's a terrific guy to listen to and a great trader. So one more thing I'm going to share with you is in one of the books that Dr. Ziamba has, this one is Stock Market Crashes, Predictable and Unpredictable. This one is his most recent book that came out in 2017. He introduces a number of metrics that you can use to determine whether or not a stock market crash is coming. And one of the things that he discusses here, this is a stopping rule model for exiting a bubble-like markets with applications. And he's both talking about when they crash, when you actually exit a position, and when it's going up, how do you exit a long position? And when it's going down, how do you exit a short position? And one of the things that he talks about here is that here's a strategy to optimally exit such markets in a crash. Trading bubbles is difficult, and even the best traders sometimes lose a lot of money by shorting too soon. The finance and economics literature has little on timing bubbles. There is, however, some interest by inefficient market researchers, for example, Stiglitz and Evanoff, etc. In this chapter, we present a model that would seem to work well, timing when to exit a long position, and basically the same thing happens with a short position. The basic idea is that there is a fast rate of growth in prices, then a peak, and then a fast decline. The model tries to exit near the peak in prices. And that's the kind of the takeaway that I want you to get from this. The model tries to exit near the peak in prices. And that's the exact same exit strategy that we use on the spreadsheet for the YMNQ and for Market Timer. I'll show you that as well. Both of these spreadsheets encourage you. In fact, the video that I did on swing trading indicated that you should exit the positions either on the long or short side on a peak, and that peak happened to be the third column of the pipeline in the flow. And so we have not seen a peak yet in that flow, because what happens is that peak, once that peak happens, then the market will go the opposite direction, and sometimes you can take a long position just based on that. And the same thing on the volatility arbitrage spread. You want to exit on the peak. And I keep saying this over and over again in the videos and here in the chat room, is that this peak, and we'll just highlight this because I like to do that. that peak indicates that that's the end of the move. And so I haven't really seen anyone ever discuss this type of trading before. And it was really kind of refreshing to kind of go through some of the sample chapters in Dr. Ziemba's book, talking about this exact same thing. It's a fast rate of growth, and then you hit a peak, and that's the optimal time to exit the position. So that's why I'm constantly talking about the bell curve. And when you see a peak in the bell curve, that's the time to exit your position. In this case, it was to the long side. We had a nice run here of about 4 days on the spread. And now we have a peak here, again, on the long side. This was a peak, and now we see the bell curve starting to come down. As soon as it started coming down, that you recognize that as the peak, and now we're going to be in a short YMNQ position, probably at least for a few days. One of the other books that he has, I believe, let me close this out. I'm definitely going to get this book. There was another one they had, Calendar Anomalies in Arbitrage. He didn't get to this yet. Let me see. I don't think it's too far into the interview, but it's really, really important. He talks about this. Let me see if I can just speed this up a little bit.
Okay, well, you've mentioned a few things which I'd like to dig into a little further. I guess one of those being calendar anomalies. So,
yeah, this is the point here. Okay, so pay attention to this. This is really, really interesting. And it's one of the reasons why, and I think it'll give you a lot more confidence in the arbitrage spread that we're doing. He talks about a specific anomaly that happens each year based on calendars, but he talks specifically about not only why it happens, but also how he trades it.
You know, when you talk about calendar anomalies, and I know this takes up a large chunk of your trading, what are you actually referring to when you talk about a calendar anomaly? Like, what exactly is that?
Let me give you an example from Japan. In the United States, we found that two things. If you take the 70-year period, 70 years from around 1920 to about 2000, somewhere around there, you find that in the single month of January, the lowest decile stocks beat the highest decile stocks by 10.3% on average, year by year. And if you plot a graph, year by year, you find that almost every year the small caps outperform. And if they don't outperform, they underperform by just a little bit.
He's talking there about, it's kind of hard to actually hear him specifically, but he's talking about small cap stocks,
etc. So the question is, how can you bet on this? So in '87, I did a paper that's reprinted in this Calendar Anomalies book where you bet on that. And the idea was you go long a stock market index future, at the time called the value line, which was equally weighted, and then you short the S&P 500, which
that's exactly what we're doing here with the YMNQ, YMES. That's the volatility arbitrage. I had like I said before, I knew that I'm not the only one who ever came up with this idea for it, and it's really, but I had no idea who Dr. William Ziemba was. I wish I had found him 20 years ago.
Evaluated large cap, and you do this from about the period January 15th to about December 15th to about January 15th. Okay, so the effect was actually in January, but it's anticipated in the futures market earlier. Okay, so that I played, and I did that for many years, and I did it for 14 years, and I managed to win each year. But it changes a little bit each year, and you got to have confidence in it that's actually going to work. It's like a horse race, whereas I learned my trading from And the thing is, the only difference is you can stop the horse race. So,
if nothing else, except to really validate the kind of work that we're doing here. So, but he said the same thing happens almost every December 15th to January 15th. We never got to the point where, I've got data going back for about 5 years with the arbitrage spread, but we see it on a recurring basis. So he's talking about an annual basis for the anomaly taking place over a 70-year period. And I'm pretty sure that he also is recognizing the fact that it happens on a regular basis in the market, and that's probably why he's doing so well. So I highly encourage you guys to complete this interview. Very sharp guy. I'm going to be ordering some of his books for sure. I've never heard of him before, but it's absolutely fantastic. He's also talking about the racetrack kind of effect that, hey, you want to bet on the fastest horse and you want to sell in fact, he talks about buying and selling the index based on, which one's faster, which one is not keeping up. And so anyway, it's really fascinating. And as long as you're there, make sure you take a look at some of these other interviews. This is episode 107 with Tony Saliba, and Edward Thorpe was also a terrific interview here. Anyway, so Greg asked, could you complete a walkthrough exactly what you look at in the arbitrage spread? So the biggest thing that I look at in the arbitrage spread, number one, is when this is peaking, just like I mentioned. As soon as I see a peak in the arbitrage spread, the bell curve. The bell curve is the most important thing that I look at when I'm looking at the sheet here. And so, typically the bell curve is going to peak right around when it's like somewhere between 9, 10, I think 15 is pretty high, but typically, anything above 10 is going to be a peak in the arbitrage spread, and you want it to come down. So in other words, you don't want it to see it continuing to go up, but you want to see the peak, and then the very next day it should go down. If it doesn't, then it's still probably in that trend. So the most important thing in the YMNQ trade is to identify that peak. And if you can identify that peak, and then you use the other tools that are available in the spreadsheet, like the binary trend. The binary trend will tell you, hey, we're starting to see a negative. This trend column particularly indicates when the trend is negative. And so you're taking a look at this and you're saying, okay, we're probably starting a negative trend here. We've got a -0 on the trend. It had been positive. Now it's starting to turn negative. So you want to see when it turns from a positive to a negative. So here it started turning negative again. Now it's going negative. So peak, trend, the trigger is just an extra thing. If it works, it works. If it doesn't, it doesn't. But basically, you're looking at the peak in the bell curve. Then you're looking at the trend to see if there's a change in trend here. And you want to position yourself either long or short based on that. The other thing that you want to look for is you want to monitor the difference in the percentage. There's no hard and fast rule about this, but generally you want to take a look at the percentage changes in each one of the indexes. So right now they're identical. They're both at -0.10. So there's not much difference in that trend change. What you want to do is you want to keep an eye on that trend change over time, and that's what this graph or this chart is telling you to do. So it was negative. We were negative here, and now we're starting to turn positive again. But that's kind of what you want to look for. You want to look for that percentage change. Who's beating who? Which one is the faster horse? Which one is declining faster than the other one? And that's also what these two windows are helping you to do. So right now on the supply-demand, we're at -3. So if you think of this as a racehorse, if your YM is your racehorse, that is declining faster than NQ. NQ is declining at -0.268. and you want to look at the acceleration. The acceleration on the YMQ is much stronger than it is on the SD. So it will eventually catch up with the strength or the YM because it is decelerating. It is declining at a faster rate than the YM. And if that's the case, then the YM is going to outperform the NQ. And that's why the spread is starting to go up. So hopefully that was helpful for you guys. A lot of good information out there, especially with the with these. I really like the way that Aaron Fifield does these interviews. And I highly suggest that you go check out the free ones. I think he's got a premium site as well, but they're very well done, very, very well done. Euchris asks, you take these arb trades at 10 a.m.? No, typically I'm in either right at 9:30 or between 9:30 and 9:45. I want to kind of see after the open, because remember, the Dow Cash Index is a rotation. And so it takes a few minutes for the Dow. The NASDAQ opens right away. It's all digital. Everything is open right away. The Dow Cash Index is still on a rotational basis. And so there's a lot of fluctuation in the spread between around 9:30 right at the open. And now it's much, much quicker than it used to be. Back 10, 15 years ago, the rotation could take like a half an hour. But now it's typically just a few minutes. So I don't get in right at 10:30. I wait a few minutes, maybe 10:35. I want to see which way the spread is going. And then I take either a long or short position based on the spreadsheet and the indication from the chart. But I wouldn't, by 10 o'clock, sometimes the spread, by 10 o'clock, sometimes the trade is over. So typically I'm in 9:30, 9:35. I'm looking at it and I'm out typically by 10:15 at the latest. You've been getting in at 9:45 and trades have been like a roller coaster up and down. Yeah, they can do that. That's for sure. I would get in a little bit earlier depending on the setup. So, for example, today I did not take a trade because there's conflicting signals here. I've got a +2 on the trigger, which indicates a possible positive trend today. On the other hand, we've got a declining bell curve. Declining bell curve tells me that the spread should be negative. So I've got conflicting signals. I only want to take the highest probability setups. If that's the case, then I want to have both the trigger, the rate of change, the trend, all of them lined up with the bell curve in order to take either a long or short position. Okay, well, money is money. $80 is good. You know, it buys you dinner, buys you lunch in some places. Euchris asks, can you decide on arb trade only from seeing the indicators on the screen versus the Excel file? You can if you look at the supply demand and you look at the strength index, that may play out a little bit differently. So, for example, let's take yesterday as an example, maybe. Negative trend right at the open here. That was yesterday morning. Big negative trend. We had the bell curve declining, so we knew that it was in the likelihood is that the trend column was also negative. So yesterday it was pretty obvious that we were going to have a negative open for the spread. And what I do is I'll take a look at the supply demand on the YM and the supply demand on the NQ, and I'll see at the very open at least the strength of the NQ was much higher than it was on the YM. And then it continued to kind of be strong. Actually, both of them were pretty strong for the entire day. But the other thing that I do, and I've shown you this before, is I measure off that first 5-minute bar. And so what happens is, let's say this is a race, And the race is to get to the end of the day above the first 5-minute bar. Well, in this case, the YM is not keeping pace with the first 5-minute bar. In fact, it's declining further and further below the first 5-minute bar. That's the starting line. So if we follow the analogy even further, the first 5-minute bar is the starting line. We want to see which one can finish the race. The YM here obviously was lacking quite a bit, and the NQ, on the other hand, was constantly coming back up into that 5-minute bar and finished the race within the 5-minute bar. So that's another way that you can determine the strength or weakness of the YMNQ without using the Excel spreadsheet. But all of these, see, the one thing that you have to keep in mind is that all of these indicators really need to work together. So, for example, if I'm seeing the spreadsheet, this is the first thing I look at. I'm anticipating a negative trend here starting. Even though the bell curve is still positive, it's declining sharply. So I'm looking for a negative trend to develop. Then I look at, where are we in relation to today's race? Well, we're pretty evenly paced right now. Looking at the first 5-minute bar at the starting line here, the YM is above it. The NQ is above it as well. We look at the supply-demand. Looks like they're pretty well even here at -3 and -2. We've got some weakness coming into the NQ, but typically I'm looking at the SD, the supply-demand only, and they're pretty well evenly matched. And if you take a look at the spread between the YM and NQ right now, it's pretty evenly matched as well. But you have to use all of these indicators and then make a judgment call. Oh no! Why did you lose? You shouldn't have lost $705 yesterday, Greg. Not on this. That was an easy setup yesterday. Easy setup. You should really become a private client. I'll teach you what you can do to fix that. By the way, all the private client slots are filled for October. I have one left for November. If you guys are interested, shoot me an email at davidtradingology.com and I can set you up with that. Well, good. I'm glad. I'm glad it helped. Absolutely. Good. Okay, good. Oh, you did send me an email. Okay, I'll make sure I respond. That was the first day back from vacation, so I was kind of busy with taking care of some business. But yeah, I'll definitely do that. All right, guys, it's 11 o'clock. We're going to call it a day. Have a great day out there. Make sure you go to Chat with Traders and check out those interviews, especially the one with Dr. Ziamba. Really fascinating stuff. It's a little geeky, I know, but I love numbers. I'm a numbers guy, and I just love that stuff. I could probably listen to it all day. All right, guys, have a great day, and I'll see you again Thursday right back here at 10 a.m. Eastern Time. Bye.